Hey everyone, I hope all of you are doing well and welcome to another podcast episode. And today with us, we have a very special guest who needs very little or no introduction, and that is Kirubakaran Rajendran sir. Sir, thank you so much for coming here and being.
Hey, thank you so much for
And
having me in this session. No, I would really happy that whatever things that I've learned so far, I'm ready to share in this overall podcast. And first thing before I start, ಚೆನ್ನಾಗಿದ್ದೀರಾ?
ತುಂಬಾ ಚೆನ್ನಾಗಿದ್ದೀವಿ
And this is ಸ್ವಲ್ಪ ಕನ್ನಡ ಗೊತ್ತು. This is the only Kannada that I know so far. So yeah, I'm very happy to be here, Saket.
Thank you so much, sir. And as we all know that you are one of the pioneers when it comes to automation and algo with square of bots, right? So like maybe there were only very few algo platforms which were existed maybe in 2021 to 22,
Yeah.
and one among them was square of bots, which gained a lot of popularity. And I guess a lot of people know you through Quora,
Yeah.
also, right? So you were pretty active on Quora, right? So I think we have also had conversations before where you had shared a glimpse of your journey on how
Right.
it started. Right. So before we actually get into understanding more about data, more about markets, or how exactly a new trader today can start trading, right? So maybe you can give a glimpse again to the audience about your journey on how it started and how you ended up being a completely data-driven trader.
Yeah, sure. See, to give a brief intro about myself, see, my father, he studied up to 10th standard and he couldn't clear 10th standard, and eventually he started working as a clerk in a government office. And my mom used to work as a tailor. And I joined my graduation in BSc Statistics in the year 2005, and that is when I started getting into the markets by end of my final year only. Prior to that, I was working in different jobs. Like I used to work in Mary Brown restaurant. I'm not sure whether you have heard of Mary Brown. McDonald's, right? So McDonald's, Mary Brown, those are chains of restaurant where I have worked as a part time. My college is from 8 o'clock to 1 o'clock. I know once my college is over, I go and work there. I worked in sales guy in high style showroom, a normal retail showroom. So those are some of the odd jobs that I've did during my college days.
Okay.
And by final year of my college, I know a person in my college. His name is Richard. That guy was the one. Even after all the college gets over, he'll be sitting at the last bench and he'll be going through economic times paper.
Okay.
And during those time, the share price of each and every stock will be printed in the newspaper. So this guy used to track in everything. And one day when I had a conversation with him, he says that this is what he used to do. And since then onwards, I started picking interest towards stock markets. And then by 2008, almost I started with whatever the money that I had. I thought, okay, fine. Let me start reading the Economic Times newspaper every single day. Whatever things that I do not know, I'll just go and Google about it. And that was the peak of bull market in 2008.
Okay.
Like whatever stocks that you buy, it eventually goes up between 2004 to 2008.
Right.
I entered exactly by January 2008, just 10 days before the biggest crash. So whatever stocks that I know, I just bought it. So I used to trade randomly. And then by 2000, I think January 2008, the first time I've seen market closing at 10:30 itself because of lower circuit.
I think two lower circuits are.
Yeah, it is 2008 January
Uh,
21st or 20. I'm not sure whether it is 21st or 27th. I don't know the date exactly, but that was by and after the Reliance Power IPO.
Okay.
Reliance Power IPO was a sensation, but after that, no, I started trading and eventually I moved from news-based trading to rule-based trading. What happened was by the time I completed my graduation, I got placed in Infosys campus interview. I worked here in Electronic City for 2 months, 2 years. So during those time, it is difficult to manage the trading as well as the job because once you are totally tied up with IT job, sometimes you will be held up with meetings. You can't scan your overall open positions. So that time I thought it is very difficult to manage it. So why don't I start trying to get into rule-based trading or algo trading? So when I started exploring algo trading in 2014, so that is when I thought if I need to spend enough time with respect to job and also manage the work, it is better to get into algo trading. And the only way that I can get into algo trading is to create certain rules which can automatically quantify it and I can place trades on that. And then from then onwards, whatever things that I started doing it, I totally shifted from news based trading to rule based trading. And from 2014 onwards, I've been doing only algo trading.
So in 14, like I suppose till 17, there was no weekly expiry. There was only
Right,
monthly
right,
expiry.
right, right.
So back then also you were into options, or you started with
Only futures. It was only
Only
futures.
futures.
Yeah, yeah. So back then, I used to design multiple trading strategies where you download the data to AMI broker, write your overall AFL codes, and try to create strategies.
Right.
I remember I created one trading strategy which I thought that is going to be my life-changing, indicator-based strategy, where people usually use one indicator or two indicators. I used to apply 21 different indicators. Only when all those 21 indicators give you buy signal, it will go for buy. I thought this is best because that was given the best backtest results. I used to save that particular AFL as life-changing AFL dot, in a secured folder. I thought that is the secret. And then eventually that folder got renamed to version 1, version 2, version 3 because you keep changing it. And eventually I realized I'm just doing a curve fitted system and it wasn't working well. And then I tried learning what is difference between creating a strategy based on market data versus market behavior. And slowly I shifted towards market behavior and started creating trend following and breakout systems. So until 2017 or 18, I was doing only futures based. And after 2019, I started getting into options.
Right. I think you would be the best person today to have and discuss about the data, having more than 10 years of experience working with different systems, working with different sets of data. So the thing is, so in my opinion, maybe post 2020, 21, when a lot of people started coming and this backtesting started becoming quite popular with stock mark, algo test and all of that.
Right.
So a lot of people started adapting a system-based trading, right? So they shifted from discretionary to system, and people who started coming in new straight out went to the system, right? So now the thing is, okay, like now there are two, like when you actually take a look at the backtest, generally it shows very well, and when you actually start implementing that, you don't get the same results.
Right, right.
So because you would have worked with data for so long, so generally, what is your observation? Is it that the people, let's say they build a good system, that they don't really run it for long enough to get the results? Or is it the matter of fact that, so what you actually get on backtest might be totally different on real, like when you try to run it on a... Before moving on, I would like to talk about the sponsor for this video. The sponsor for this video is none other than First Talk. You might have already heard me talk about First Talk quite a lot of times in my earlier video. First Talk is coming out with a brand new platform for trading as well as investing this January. The platform is going to be really advanced and very simple to use, and you can get early access to this platform plus 2000 rupees worth free brokerage credits by opening a free First Talk account today. Just click on the link in the description and you will get your free First Talk account plus the brokerage credit and the early access to their advanced trading platform. So do check that out. And also, since it happens to be Deepavali today, so I would like to wish you all a very happy Deepavali. I hope the next Samvat is actually going to bring you a lot of joy and prosperity. Now let's quickly move on to the video.
Right, I get your point. See, earlier 10 years before, the difference was you do not have enough resources to backtest. If you have to backtest, you have to know your AFL codes and everything. Now people have access to no-code platforms where with the click of a button, you can easily backtest straddle strategy, strangle strategy, which much easier. You don't need to go no coding at all. You just place the respective legs, mention the respective stop loss, it gives you the returns. What happens is, no matter what straddle or strangle you use, any kind of stop losses, people try to optimize the stop loss parameter to a greater extent, where they initially try with 10% stop loss, then they try with 20% stop loss, and eventually they finalize with the one specific stop loss, which gives the highest returns. So most people approach the problem in a wrong way, where if I could create the best backtest results, I'm going to see that in the future. That is not going to happen. So I'll explain you with the difference, how you can create a trading strategy based on market behavior with ChatGPT plus TradingView. Using this, I'll now try to show how it works. Okay, let's start. See, Sakil, so when you backtest any specific trading strategy, you just go to the specific platform and mention the start date and date. Say, suppose if you're testing a short straddle strategy, a 25% short straddle strategy on call option and put option. So this is how it would initially look like, where between 2022 to September 2023, the overall maximum drawdown was only 6,000. So you are trying to deploy it in live, and the moment you deploy it, in the next couple of months it moves to 8,000, and in next couple of months it moves to almost 18,000.
Right.
So your maximum drawdown increased 3 times in the next couple of months once you have gone live. So people tend to think that okay, the strategy stopped working because most people use 2x of maximum drawdown to stop the strategy. But this is something where you are ending up with a curve fitted system. Instead of this, you should use a different approach. So start with observing the market behavior first. Let me show you how to observe the market behavior with ChatGPT.
Sure.
So that will give you an idea. We will first observe how the market behaves. So how do you track the intraday volatility? So if I ask you, can you tell me how do you track volatility of intraday? How do you calculate the range of the day? What would you say?
So based on the high and low, the market.
Yeah, right. So basically, high minus low gives you the range, but high minus low would not give you the correct volatility of the market. So instead, what we are going to do is check how far the market has moved from open to high, day high, and how far the market has gone down from open to day low. So this gives you a perspective of how the market behaved from the moment they opened, and from the moment it went how far it has went down and how far it has moved up. So if I could track the intraday movement, then it can give me a certain assumption like how far the market has moved and how it has behaved on all days versus on expiry days. So we will ask ChatGPT to give a Pine script code which can plot open to high and open to low in percentage terms. And then we'll observe how the market is behaving. So I have mentioned I wanted to track open to low and open to high in percentage terms. Please create a TradingView Pine script which can plot this movement in a separate chart.
So I think even here, when it comes to asking the right prompts, like how you said, matters a lot. So you get the exact output of.
Right. Even sometimes if you're not able to get the exact output, even if there is error, if you just copy paste error, it would give you the right script. So currently we are asking it to create a Pine script. So I do not know Pine script. I do not know much coding. I know an overall view of AFL and multiple things, but I cannot write coding from the scratch. So what I always say, there are good traders, there are good coders, but there are very few good traders who are good coders. So if you are someone who was not having enough background about coding, you do not need to worry about it at all, because with respect to these platforms like ChatGPT, that can give you the right prompts. You just give the right prompts, it will give you the right result. So it has given me the code, like see, and it mentions like how it works. Open to high is calculated, open to low is calculated. I just need to copy this code and go to TradingView and paste this Pine script. It is going to plot me the complete graph. So usually this is how the TradingView chart looks like. Once you open TradingView and click on Pine editor, it would allow you to copy paste the code which you have taken from ChatGPT. And once you click on add, it is going to add that particular chart. See here, now it has given me how much percentage it has moved from day open to day high, which is in green color, and day open to day low, which is in red color. So this has given me the complete details for all days. So I can track here how much percentage usually it is being. So sometimes it is mostly less than 0.5%. Sometimes it is greater than minus 0.5%. So most of the time, if you analyze the overall behavior of the markets, it is oscillating between minus 0.5 to plus 0.5. So mostly the ranges are narrow. Sometimes the ranges are getting widening. So now we need to track the same details only on Wednesday. Since Bank Nifty expiry is only on Wednesday, I need to observe how the overall expiry has been. So now we'll ask the ChatGPT to do the same thing, where give one more condition. I want to track it only on Wednesday. So go to ChatGPT. It mentioned that it works fine. I want to track the same only for Wednesday. That's all. Now it would add the necessary day filter conditions into it, and then it would give me the code. So you just copy paste it, then that would give you the actual movement only on Wednesday. Yeah. So once I copy pasted the code, it has given me the same plots where only on Wednesday it would show you the values. So if you see it here, the values will be displayed. Okay, market has moved 0.65% on the upside. On the downside, it did not move much. So overall, you will have an idea that most of the time market is oscillating between which range to which range on expiry days. So this is a visual representation. So now we need to know a numerical representation. So okay, overall I'm seeing that most of the time markets are narrow. Can you tell me how many number of times during Wednesdays on expiry days the market has closed between minus 0.5 to plus 0.5.
Right. Here I have one more question, sir. Actually, let's say, so this is giving us a range, right? So it might have happened that this range can be achieved due to spike, right? So when there is a sudden spike, the let's say open to high or open to low might be hit. So now when I am trying to create a strategy around it, right, maybe by keeping a stop loss or keeping a this thing, let's say I'm not hedging it, right? So isn't it likely that in a spike, so even though the market is ending within a range, right? So my stop loss would actually get hit.
Yeah, right. Because you're placing a stop loss based on the premium.
Right.
So instead, what we are going to do is create a trading strategy which is based on the market, whatever the observation that you did, based on that create a strategy which will rely on the underlying move instead of the premium.
Okay.
So let me show you how you can track it and create a strategy totally based on market behavior using an underlying stop loss.
Got it.
So what I did is I again asked ChatGPT to give me the total number of occurrences, how many days where there is a percentage of from day open to day low is greater than this many X percentage, and day open to day high this many X percentage. Tell me the overall counts. Then it is mentioned that out of 387 expiries from 2017 to till date, there were 175 days where open to high is greater than 0.5%. Okay. 182, which is approximately around 47%. And 45%, mostly 45% and 47% of the time, market is oscillating between this range. And which means that once it crosses beyond this range, market could be in a trending phase. So what we can do is create a short straddle strategy at day open at 9:16. You create a short straddle strategy at 9:16 with shorting at the money option and at the money put option. Instead of using a complete random stop loss of 10% or 20%, use this as an underlying, where as per the market behavior, it is shown that most of the time, market is going to oscillate between 0.5% and 0.7% on the downside and 0.5% on the upside. So what I can do is, let me go and open an Algos platform and show you how I can, using this data, I can backtest and create a strategy. See, what I did is, we are going to enter into the markets at 9:16 as soon as the market opens. And I've selected Bank Nifty. Okay. And I've selected call option and I've selected put option. And it has shown that most of the time the market open to day high is 0.5%. So I've selected underlying as a stop loss, not any on the premium. So I've mentioned 0.5%. And on the put option side, instead of mentioning 0.5, I've mentioned 0.7 because comparatively market goes a bit lower most of the time compared to going on the upper side on expiry days. So I've mentioned 0.7% because this is the same input which we have seen from our own ChatGPT analysis in TradingView. So now using this, I've given 10 lots, and I'm going to backtest from 2017 to till date. That's all. So the rules are simple. You enter the day open and give a stop loss based on underlying in short at the money short straddle and run a backtest. So this is going to give you how the overall results would look like from 2017 to 2024, inclusive of all days. So now you can figure it out how the overall returns is going to be on expiry days on 0DT. So even during these kind of spikes and everything that has happened, right? So it will show you how the system has fared even in spite of all these movements. So this is the overall movement. So for 10 lots, it is given approximately how much? 48 lakhs. So let's add all the charges into it. So add 20 rupees brokerage, add transaction charges, add slippage is also 0.3% and calculate everything. So now the returns is still 35 lakhs for 10 lots. And if you see the overall expectancy and overall drawdown everything, if you see, it calculates. So for 10 lots, almost 3.5 lakhs is the overall drawdown. And it has made almost 35 lakhs. So 10 times of the drawdown it has made, considering trading on all days. So if we do it only on 0DT, so this is the drawdown. So from 3.5 lakhs, the drawdown can come to only 80,000.
Okay. And what is the overall return?
Overall returns is 16 lakhs.
And expectancy would be?
Almost 0.36. Okay. So from 0.18 it increased to 0.36. This is after all brokerages, transaction charges, slippages and everything. And inclusive of the rough days that we have seen this whole year. So if you see this year, it made almost 2.7 lakhs returns. Okay. And with 67,000 drawdown.
That's pretty good.
So this is we did not wanted to create a short strategy directly. We went to ChatGPT, we asked for certain information, then we went to TradingView, we observed the market behavior, we could see that market has been in a range bound on expiry days between 0.5 to 0.7. Accordingly, we came to the backtest platform, given the condition, created a system. So this is something where a right approach, instead of creating a based on market data, creating based on market behavior.
So I think most of the people, like generally what they do is that's where they spend up most of their backtesting credits also.
Right,
So
right. Yeah, that is true.
Yeah, they keep trying to optimize, because I know a lot of people, right? So when they come and speak, like when they try to optimize between 37 to 39, they're like percent.
True. See, this happens during initial phase of any system-based trader. Even I have gone through same scenario where my only criteria is to get the best backtest results. And I used to do the same optimization in AMI Broker, where if you run the optimization, it will give you in seconds which is the best moving average, which is the best super trend. I used to run multiple analysis, and whatever the best moving average that was for that year will not be the best for the next year, because the same set of occurrences will not happen. So do not give too much importance to these parameters.
Got it. So now my next question to you would be, okay, now this ChatGPT is more like a commodity available to everybody.
Right.
So TradingView is available to everybody.
Right.
Now the data is available within seconds. Right. So with all this so easily accessible to people, right? So and when people start optimizing more and more, and people start backtesting, trying to build systems. So will we come to a point where the simple systems of maybe, let's say, keeping a stop loss of say XYZ% will stop working? So can we reach that system, or because fundamentally short straddle has a higher tendency to make a profit, do you think it might still continue to work maybe over time? But what is your take?
So it depends upon the crux of the system. You don't take example of options. Take any specific systems, be it in stocks, be it in options, be it in futures. If you create a trading strategy which is based on core underlying principles, that would last longer for a long period of time. If you take Bilden is one of the famous hedge fund investor who manages billions of dollars, who still manages more than $1 billion. And this guy has been running a same system from 1974 to till date, which is for almost 50 years. He's running a system without any changes. And if you see, that particular guy has outsized return, given outsized returns to his investors, where he has beaten index to a greater extent. But this is something where the guy created a simple trend following system and sticking to the system irrespective of multiple drawdowns.
So is there a way where maybe you can show us quickly?
So Saket, this is the overall now P&L distribution. Like I have the dates. Okay, usually every backtest data will have a date and the respective returns. Right. So I've taken the date and I've taken the respective returns and I've plotted a drawdown. Okay, and this is from 2021 to 2024. This is my live returns of my expiry days. So I've plotted the overall drawdown. So if you plot the overall drawdown with this data, you are getting overall 8%. Okay. So based on this data, you have consider this as a backtest system, and you have backtested it, and it is showing 8% overall drawdown. And now we need to know what would be the worst case scenario. So the worst case scenario is.
So these are the actual the data or the simulated numbers.
Like these are the actual live data, but I'm asking you to consider this as a backtest report. Okay. So I'm now trying to show, take a backtest report and try to come up with the worst case drawdown. And how do you come up with worst case drawdown is just simply do a Monte Carlo simulation where you have to reshuffle the P&L. Say suppose on 30th September, 1.4% is the returns I got. What if in case that day returns is replaced with 28th of October returns, which is minus 0.1. Okay. So you just reshuffle these two. Then the P&L varies, right? So like that, you take 1,000, 10,000, 20,000 different iterations, and it would automatically plot a worst case scenario what it would. So this you can do it with ChatGPT, or if your system is based on options, you can directly do it in Algos. Both the platform you can do it. Let me show how you could do it in ChatGPT. Sure. Yeah. So what I did is I directly uploaded the result file, and I just mentioned, right, I want to run a Monte Carlo simulation on my P&L, where you reshuffle the P&L and give me the worst case scenario drawdown. So it would plot the possible maximum drawdown after 1,000 iterations. It just reshuffles multiple times. And once I given this command, it automatically started writing the code for me and started giving me the necessary output. Like this is the output where it is clearly shown where the maximum drawdown maximum worst case drawdown could be 14%.
Got it.
So in the backtest it was 8%. So it ran 1000 different iterations,
Got
and
it.
after that this is the worst case scenario it was given. So now when you start trading live, you just need to be prepared that okay, my worst case scenario could be 14%.
14%. I think this is going to be pretty helpful even psychologically when you know that okay, this is what I should actually prepare myself for.
Right.
So this actually brings me on to my next question, sir. Right. The thing is, let's say what really ends up happening is as like I think we might already be seeing that, and more people get into trading options. So generating alpha with options starts to become harder. So where you could easily generate 30-40%, right, at a point in time, maybe in 17, 18, right. So as you go forward, it is becoming harder and harder to get that alpha, right. So now let's say somebody is really coming into trading maybe with a capital of 5 lakh or 10 lakh, right. So considering all the charges, everything that he has to pay, right. So, and also the environment as a whole is becoming so challenging. So, is it really worth for him to come take that stress and try to generate returns and worry?
Yes, we are making this as a stress only because we have seen a golden period, specifically option sellers. You would have seen a golden period 2021, 22, those periods, like you do any kind of option selling strategy, it ends up making good profits, right? And people were so used to those kind of environment that okay, they tend to think option selling is so easy, and eventually it became so much crowded and a lot of spikes happened, a lot of zero DT traders came in, and because lot many people are having access to the same kind of weapon. Consider we are going into a battlefield. What happens if the opposite guy and we both comes into our equal strength, coming with equal weapons and trying to fight? Obviously it will not lead to a victory to any of us. Only a guy which is bigger fish, who is having much sophisticated tools or who is having much access to the larger base like Gen Street. So obviously they are trying to capitalize on this and they are trying to make good profits out of it. So if someone is coming into the markets with 5 lakhs of capital, first thing is it is not mandatory that you need to try that only in options. You can try it in stocks, you can try it in futures segment. If you're trying it in futures segment, don't try with more number of trades strategies, because a higher number of trades, the STT is 10 times higher in futures compared to options. So try to play around with swing trading systems where it creates 2 or 3 trades. So I know certain people who have been trading in futures really well. So they try to do on a momentum basis, try to do on a trend following basis, where you just have to capture a couple of trades that is going to give you larger profits. So it is not mandatory that we need to jump into options. So the options place is so much overcrowded, and lot many YouTubes or channels are there which specifically talks about options. So they tend to project in such a way that option selling is the only way to make easy money, but it is not that.
So the thing is, like how you said, right? So everybody is getting lured into option trading because you can make easy money. Okay. So do you think so that we all know that the derivative volumes is highest in India, maybe easily 3-4 times higher than the next exchange that is available out there.
Right.
In spite of our economy being 6 times lesser than the top economy, right? So it really brings on to the question. So one, let's say it's about the population who wants to make quick money. So do you think fundamentally in the economy, because if you take a look at India as an economy, it is growing, it is booming, stock markets are booming. So the rich is getting richer, the poor is getting poorer. So fundamentally, there are aspects of economy where people are not having enough disposable income, and that is forcing them to maybe come into markets and try to...
Okay, so you're saying that with respect to the overall fundamental shift in the economy where more people are unemployed, they're coming and getting into the markets. See, I would see it in a different way. It is not because of lot many unemployments people are coming into the markets. It is mainly because of lot of employments are there, which leads to a lot of surplus cash, and that in turn makes more people think that stock market could be a secondary income. A guy who's not having an employment will never come into the markets. They can't think that, okay, I do not have any job, now let me go to the markets and start making money. That is the last thing that they would do. But a guy who's making 1 lakh a month, 50,000 a month, 30,000 a month, they tend to think, okay, let me try with 10,000 rupees. Let me try with 50,000 rupees because I have enough cash now to play around with the markets. So it is not that unemployment is creating more people coming into the markets. It is rather the employment, access to the surplus cash, that is pushing more people coming into the markets. Still people think that it could be a secondary source of income that they could think from the market perspective. That is not possible. So making a secondary source of income from markets, thinking that you can pay your EMI, you can pay your additional rents and everything through markets, is totally a wrong approach to coming into the markets. It is not much easier to be making an additional source of income by just getting in and trying in multiple things. It's not easier.
So, okay, now, how you mentioned with respect to a lot of people coming into the market, right? So we have also seen the surge in SIP numbers.
Yes.
No doubt about it, right? So I remember when market hit 22,000, people thought, oh, the valuations were pretty expensive, and as soon as it corrects 10%, I'm happy to put, right? So today market has gone to 26,500, 26,300.
And luckily we saw some corrections today, I think.
Right. So from here, if it corrects 10%, maybe will only come down to 24,000 and not even 20,000 like how they're expecting. Right? And now the same people are ready to put at 10% correction from the top, where they could have actually invested at 24,000.
Right.
Right. So the money doesn't seem to stop. The SIP flow is continuously coming in. Right. So the real question is, okay, for today somebody who is earning and bringing the markets, right, coming into markets. So we already understood maybe with a smaller capital, option is not the place to explore secondary source of income. Do you think at this point in time, the markets are reasonably valued for him to get a decent return? I will tell you why this question is coming. Right? Maybe if you had put somewhere during the peak of 2007, 2008, right? And you had to wait almost close to around till 2013 or 14, maybe that was close to around 6.5, 7 years, before you could actually make a substantial gain.
Right.
So my question is coming from your perspective, totally from your perspective. Are we overvalued, and is the risk to reward favoring at this juncture?
See, two things with respect to an investor perspective. If you are a person who is trying to make a lump sum investment, obviously you have very, very few opportunities right now because everything is super overvalued. But these lump sum investors, for an example, consider 2020 crash or 2008 crash. So those are the very few opportunities that you would get where you can put in a reasonable amount of money or lump sum money, where most of the stocks are available at a much cheaper price. So with valuation point of view, obviously you can't look for a valuation on a bull market because everything is going to be super valued. But if you are an SIP investor, where I have did multiple analysis, where if you are an SIP investor who starting at the peak, if you started at the 2008 peak and if you continued your SIP, still you would have made money. Right. And if you are an SIP investor who wants to make an SIP now, thinking that market is overvalued, if you wait for a correction, definitely the correction may come or may not come. What I have observed is, if you are an SIP investor, where if you make SIP every single month consistently over a period of time, that will give you an higher returns rather than if you are an SIP investor who just keeps accumulating your overall SIP cash and try to invest only when there is a 10% correction in the market, 15% correction in the market, then you will not be able to beat the returns of a regular investor. Where I have done the same research in ChatGPT, where if you give the conditions, it would plot the overall investments that you would have made in consider any kind of index funds. It would show a complete differentiation between a guy who has made SIP every single month versus a guy who is trying to invest only during 10% correction, 5% correction, 50%, anything. If you change it, it will not beat the other guy who is regularly making the SIP investments. So valuations will always be higher, but with respect to SIP, it's better to stick to it and consistently run it for a longer period of time.
Yeah, so now that again, as we are approaching the end of this podcast, so I have a couple of questions which I want your view on. So
see, yeah, before that, I'll actually show this SIP thing so
yeah,
that
sure, yeah, that
so
would
that
be
yeah,
pretty good. Right?
Because people should know. Because most of the people whom I have spoken to or know people who wanted to do SIP, they tend to do this. They wanted to wait for the market correction and then they wanted to do an SIP investment. But if you do this, I'll show you how vary the overall returns is going to be. So what you're seeing right now is the Sensex chart, okay? And Sensex chart is there from 1980, I think. Yeah. So 1980, from 1980 to till date, we have that where market has gone through multiple crashes, right? So there were 2008 crash, there were 2020 crash. Irrespective of every time, if you just keep putting 10,000 every month as an SIP, your overall investment would have grown to this much, where you ended up almost now investing how much? 10,000. So 54 lakhs.
Okay.
So now your overall SIP amount has
This
been.
is from 1980.
Yeah, right. And your overall returns is 47 crores.
Okay.
So you made an SIP 10,000, 10,000, 10,000 every single month for the last 45 years, and you accumulated almost about 54 lakhs of SIP. But returns wise, if you see, it is almost
100x.
47 crores. And second thing is, this is 10,000 rupees SIP from 1982 till date. But 10,000 rupees value of 1980 is almost like 2.5 lakhs now.
Yeah.
So nobody could do that. Instead, let us make now changes to this, where instead of investing 10,000, start with 500 rupees. 500 rupees in 1980 is equivalent to 11,000 or 10,000 right now. So just invest 500 every month, and after 1 year, increase it to 10%. So 550. Likewise, if you keep increasing 10% every year, what would be your overall investment corpus, and what would be the overall returns if you see? That also will see. So if you see that, so how much we have made? 10,000 lakh and lakh. 45 lakhs is the overall SIP, and overall returns is 53 crores.
Okay.
So even if you start with 500 and then increase it slowly with 10%, 10%, 10%, and overall you have accumulated 45 lakhs of SIP amount, and that has grown to 53 crores. And now if you come back to the same point, where if you just invest only on market correction.
Why do you think this has happened? The reason why I am asking is because back then the skew was more like it was equally balanced. Now the investment skew has come more towards the later half, because you are starting with 500 and maybe now you are investing.
See, that is like because 500 rupees at that time, if you are
that I got it.
no, why we are need to increase it over the longer period of time?
No, that also I got it. But the question what I am having is, like what I expected at least out of this, to be honest, is maybe since we have put 10,000 in 1980 itself, so that would have maybe grown much faster and much higher than.
Yeah, the number of units which you have, so that is why it has still grown. But the overall amount over the longer period of time, your investment is static, right? So 10,000, and as the index grows, the number of units that you purchase keeps going down.
Got it.
Initially, you would have purchased longer amount of units, but over the longer period, since towards 80,000 levels, the number of units goes down, and whatever that which we have purchased at that point of time, that is appreciated, and that is why you have seen 47 crores here. And here the 500 rupees is there, but the 10% incremental after certain period, overall investment value increases.
Got it.
So by nearer to that current 80,000 values or 50,000, 70,000 values, your overall units purchase would have been higher. So that is why compared to that, this is a bit higher. But the best part is, if you do the same thing with respect to 10% correction, where you keep accumulating 10,000 rupees and invest only when there is a correction in the markets.
Okay. So you mean invest a lump sum or invest?
Yeah, say suppose I am waiting for market to correct 20%. Okay. So in this case, every 10,000 I just keep accumulating it. It will be in cash in my own bank savings account. And by the time 20% correction happens, put all this lump sum at that point of time. So you are investing a huge corpus when market is down. And as long as it is down 20%, keep investing 10,000. The moment it goes back from 20% correction, stop investing, accumulate cash. So this is what most people will tend to think, that it will give higher returns, right? But if you see, the overall investment is around same 54 lakhs, but it has given only 25 crores returns.
Okay.
So the overall return corpus is much lower. There we have seen some 47 crores. Here it is only 25 crores. Because you instead of waiting for the 20% correction, you are losing a lot of rallies.
Yeah, got it.
So when you are doing SIP, it is better to do every single month. So this is something which I learned from the book called Just Keep Buying by Nick.
Okay.
So he has done the same analysis in Dow Jones with 100 years of data.
Okay.
So that was fantastic, where he has shown the same thing, where just keep investing regularly. That will beat down every single kind of analysis which you have gone through. If I make this changes to 10%, 5%, whatever the percentage, still it would not beat the other returns.
Got it. So I think that gives us a very comprehensive view of maybe market investment and trading. So before we end this, I want to ask you regarding this recent changes made by SEBI with respect to F&O, right? So I will tell you my opinion. So I would also like to know your opinion. So I feel maybe by just increasing the lot size or the notional margin value of a contract, So in my opinion, it might not really serve the purpose of what SEBI is thinking. Right, so I feel maybe a person who is buying a 100 rupee option will tomorrow buy a 50
Agree.
rupee option,
Agree.
and a person who is trading naked will go hedge and end up trading the same quantity.
Right.
So, do you think so? It's a sad thing that 60,000 crores have been lost over, like, let's say, a notional loss and 1.8 lakh crore of net loss, right? So, do you think what SEBI has done is a step in a right direction, and does it really going to solve the purpose?
See, with respect to regulatory changes, there were if you read the book Bull, Bear and the Beast,
Right.
it was written by Santosh Nair from CNBC. So if you read that book, he has mentioned whatever the changes we have seen from SEBI standpoint of view from 1994 to till date. So there were a lot many changes. So these changes will happen, will continue to happen in the future also. But there are certain things which is good, there are certain things which is not good. So as you rightly said, increasing the overall contract value 5x or 6x is not going to save the retailers. In fact, the guy who is going to come and play with 10,000, now he has to come and play with 50,000.
Right.
So the guy who used to lose 10,000 will lose 50,000. So the ratio of people who are losing will always be 1:10. So one guy will make money, and 9 guy will lose money. That will be there. But to a certain extent, the overcrowded space of options will now slowly move away. So the overall regime will change. But the concerning part is with respect to the traders who are super active in the markets, where they have spent so much of time in creating a strategy, where they say, okay, finally I've created a strategy, and they'll finally sit. And suddenly from 2014 market shifted, where a lot of spikes happens. Now again I have to go to a drawing board and again start creating certain changes to the system so that I'm not affected with respect to spikes.
Got it.
So now I'm going and sitting and calmly, okay, finally I'm done with my work. Now there is new regime change will happen because of whatever the regulatory that they have done. So again, I do not know how the market is going to behave after November 2020. So this is the kind of a constant pressure that will always be there with respect to traders made. Imagine someone who has made very good returns, okay, and he has relied on Bank Nifty and Fin Nifty expiry, thinking that he has quit his job and he is coming to the markets. What kind of mindset that he'll be in? Now his uncertainty will be in no different extent. So it is way hard to become a full-time trader. So that is why it is essential to have a secondary source of income where you do not completely rely on trading. Even if it is an FD, even if it is a rental income, something to take care of your monthly expenses so that the pressure will not be there. So it is always these kind of regulatory changes will come and will go. There will be certain regime changes that will happen, but you need to adapt and move on.
Right. I think that more or less sums up how a trader should look into it. So just to give you a summary of what we have spoken today. Right. So sir rightly mentioned, so first we spoke about his journey, then he rightly mentioned how people can actually start approaching markets if you want to get into trading. So then what is the mindset that you should approach the market with? Then we also spoke about investing as a broader topic, where we spoke about whether doing SIPs, whether doing lump sum, what would work out, and also from the valuation standpoint. And finally, we just touched upon the regulatory aspect and how exactly things have been changing and how it brings pressure onto a trader and how he can offset it with maybe having a solid secondary source of income. So with this, we also come to the end of this 1 hour podcast. And sir, thank you so much for coming here. And
thank you, Saket. We wanted to keep this as a short film, but it went into a feature film because of long shots. So hopefully, I think whatever things I wanted to convey, I've conveyed. Thank you so much.
Yeah, thank you so much.
Thank you, Saket.